You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Carrie Lutz. Today is 2/3/22. Well, you've been in business, been in small business, owned your own company. You build it up to a certain point, and then you just want to leave. Maybe start your next venture. Maybe you want to retire, spend more time with the kids, more time with the family. How do you do it? That really is the question. And we have the answer for you. And that is a new book. And that is a new book about to be released, Exit Right. The authors of the book are with us now, Mark Achler and Mert Iseri. Gentlemen, thanks so much for coming on the show. You, Mark, have had a lot of experience, early employee of Apple, head of innovation at Redbox. You're an adjunct professor at the Northwestern Kellogg School of Management. So this is something that you think about a lot. And you, Mert, founder of SwipeSense, a health company that was acquired by SC Johnson in 2020. You've been out there. So you both have taken the exit ramp at one time or another. Mark, when you're looking, when do you start thinking about your exit? Do you start thinking about that when you start your company?
Absolutely. So especially if you're taking other people's money. If you're an entrepreneur and you don't have investors, you don't have shareholders, you have the luxury of working at your own pace on your own agenda. But if you take other people's money, if you have investors, the minute you take their money, you're also taking their agenda. And typically their agenda is they want to have an exit, in the 7 to 10 year time horizon. And so when you start a business, you also need to think about eventually what type of exit would you like? Do you think it's going to be a strategic investor, acquirer? Do you think it's going to be a financial acquirer? Why would they want to invest in your company? What value can you bring to a potential acquirer? And we're big believers in the long relationship. So starting the process, even from the beginning, of forming relationships, building trust, starting those relationships with potential acquirers so they get to know you and so you get to know them, because it's bi-directional. As many questions as they might ask of you, you certainly should be asking of them.
All right. And Mert, obviously you've taken the exit ramp a couple of times. For you, what was the most important thing in your exit strategy?
It was actually realizing that it wasn't about us. It was about the buyer. As an entrepreneur, the most important thing in the world is for you is your company and your team and your customers. I mean, that's what you wake up in the morning. That's what you go to bed at night thinking about. We all know as operators, we're obsessed and we're just focused on exactly what needs to go right in our business. And we worry about things that's going to take us out. And, that's a never ending journey. It's always gets more and more intense. In an ideal exit, you, for a moment, need to suspend that it's just about you, and need to expand your horizon into thinking about you plus the buyer. What can you two accomplish together that's better, that's more impactful for your customers down the road, that ultimately only you two could do this together? What is 1 + 1 = 100? This is an exercise in empathy. This is understanding what the buyer's objectives are and how you can align your goals with the buyer's goals. So together you can accomplish something that you two individually could not accomplish individually.
Right. And so how specific do you get when you're planning your startup, Mark, as far as your exit strategy goes? Do you think in terms of getting bought out, sell to your employees, sell to your largest competitor? Are these things that you think about?
Sure. The answer is yes to all of the above. Obviously, every business is unique and different, and there's different exit strategies for each individual business. But the options are relatively straightforward. So you just named a few of them. And the real question is, when you are selling, what is the buyer going to be valuing? Are they going to be valuing top line revenue? Are they going to, is it a book of business? Do they care about EBITDA? Are they really financially oriented? Do they care about intellectual property? Maybe you have a patent portfolio if it's a tech company, for example. And so the real question is, where do you think the potential acquirer is going to value, and how can you tweak your business ahead of time, maybe 18 months or 2 years ahead of time, ahead of a potential exit, as you start thinking about an exit, so that you can optimize for where you think the most likely buyer, the most likely outcome will be.
Okay. And Mert, what do you think differentiates a successful exit strategy from a failed exit strategy?
When we first started writing this book, we'll be upfront. I mean, Mark and I are both experienced operators. So we thought of this process as sort of like documenting what we already know. What we realized was there was such a wealth of knowledge that we gathered through talking with serial entrepreneurs who sold multiple companies, prolific buyers like the Facebooks and the Amazons and the Googles of this world, M&A lawyers, investment bankers. And right off the bat, our intuitive answer was, well, yeah, highest bidder. The person who's going to pay the most that's the best exit. That's what we walk away with the most amount of financial freedom. Hooray. And then we realized that there were some patterns that were emerging. And we realized that a great exit looks less like a short-term financial transaction, and it looks much more like a long-term business partnership where there's a mutual objective and a rationale in place. So when we started hearing some patterns, we codified them in a framework that we call FAIR. What are the elements of a successful exit? Their acronym spells out FAIR. It's fit, alignment, integration, and rationale. Great exits have 4 of these elements. Fit is cultural fit. Do we get along as two parties of people, these two companies getting together? Are we going to breathe the same air? Are we going to speak the same way? Do we value the same things in life as businesses? Alignment is alignment in terms of where we're going as a company. Are you aligned internally with your stakeholders as a CTO, aligned with the CFO? Am I internally aligned with my team, with my board? Integration is the plan in which these two companies come together so we can start delivering mutual value as fast as possible. And then and only then the rationale. What is the simple reason of being of why these two companies should come together, which, by the way, is the best way to get the highest price for your company. It's ultimately about fulfilling that rationale, and that rationale has the highest dollar value than anything that you could accomplish on your own in terms of your own metrics and your values. So this FAIR framework is sort of an easy path to determine if this is the right exit for you, if this is the right partner for you to go down this road, because it's certainly one of those no turning back moments. And if you're selling your company, hopefully you're selling it only once and do it with the right partner in place.
It's funny you mentioned that, Mert. I know a certain entrepreneur down here in South Florida, restaurateur, and he's mastered the art of selling restaurants, successful restaurants, I might add, not a pig in a poke at all, but to people who put down enough money so he walks away happy, but then something happens and he winds up taking the place back. And he sold these places multiple times. And it's not that he sabotaged the acquirer or didn't disclose things in any way. It's just stuff happened and he took it back. So your exit strategy, obviously, if you're selling your company to a publicly traded company, a large company, Silicon Valley, whatever, you're not so much worried about getting it back. But you're a mom and pop shop, you're selling it to another entrepreneur, mom and pop entrepreneur, you might wind up getting this thing back. So is that part of your planning here, Mert?
Don't just survive, thrive. The Financial Survival Network.
Goldterra Resource Corp is a gold exploration company that has assembled a highly prospective district-scale land position on the doorstep of the city of Yellowknife in Canada's Northwest Territories. Goldterra is currently focused on expanding and delineating gold resources at the company's Yellowknife City Gold Project, with a goal of discovering over 5 million ounces. With ready access to infrastructure and multiple high-grade gold discoveries, Goldterra is on track to re-establishing Yellowknife as one of the premier gold mining districts in Canada. Goldterra Goldterra trades as YGT in Toronto and YGTFF on the OTC. For more information, go to goldterracorp.com. That's goldterracorp.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Well, for us, we wrote the book mainly for venture-backed tech entrepreneurs, although the lessons that you derive from it really do apply to generational companies, family businesses, businesses of all sorts. Because ultimately what you're optimizing for is longevity. What you're optimizing for is the long-term journey. I mean, getting the business back doesn't sound like that bad of an outcome when the alternative is the tech company writing off the investment that they made and the dream going to zero. I would argue that that's a much worse outcome if you don't follow these principles. So the whole idea here is we say yes and. Ultimately, this is about writing the partnership into the ultimate outcome where both parties achieve their long-term objectives. And it's much, much better if these are laid out upfront in a transparent manner in terms of what success looks like. This is sort of the core of what a successful integration strategy looks like. Mark, I'd love to hear your thoughts too.
Yeah, well, we believe in long-term relationships. We don't think of business as a zero-sum game where the transaction is the end-all, be-all, that's it, you're done. We think, the question we ask entrepreneurs is when they sell their business, if they had investors, would those investors invest in their next business? Would their employees come to work for them again? Would the acquiring company want to acquire their next business? And so we believe in the value of long-term relationships, that the transaction is a moment in time. It's not the end of time.
Okay. Well, I'll buy that. I think that's a reasonable strategy. So what three pieces of advice, Mert, would you give to a person who's doing a tech startup? Because that's what you're specializing in. But like I said, and like you said, these are universal concepts that I think apply to anything. But somebody who's starting their business today, what three things would you tell them to do?
The three pieces of advice are the follows. Start early, maintain an annual exit talk, and then look for fair elements in your right partner. I'll break them down for you. Starting early is all about building an ecosystem of buyers years in advance of the eventual transaction. Now, we've heard the advice, don't worry about the exit. Just build a great business. The exit will take care of itself. And there's a sort of this fantasy that you're sitting in your corner office, phone rings, it's Jeff Bezos, and he says, I want to buy your business for $100 million. I mean, this feels like it's straight out of a movie because that's just not how reality works. The reality is the folks that are buying your company are ultimately buying the trust they have in you, in your statements, in your ability to portray a future vision that you can get there together. This is really hard to create with someone who's just met you. It just feels very transactional. It doesn't lend to a long-term partnership. So what we advise our founders to do is start early in building those relationships with the potential acquirers of your business. Show up with them to an annual dinner, meet with them in trade conferences, add value to them, not like sharing your financials with them or giving them your customer leads, but make sure that you're breathing the same air with them because you might be on the same side of the table down the road. I myself have made this mistake. I thought, I'm a competitive person. I want to win. I don't want to talk to my competitors. I hope all their businesses fail. And this is sort of a short-sighted view of eventually what ultimately, hopefully, in your case, is a successful long-term partnership. So this is all about building that ecosystem and being a known entity in that place. Now, the second thing is about having an exit talk. Right now, talking about exiting your company is a taboo subject. Let's just call a spade a spade. It's weird to talk about this with your team. It's weird to talk about this with your board. Heck, it's weird to talk about it with your family, internally, like when you're thinking about, here's where I wish this business can go. The reason is it feels like synonymous to quitting. Like, I'm exiting because I'm tired. I'm done with this. Where in reality, it really should be framed as how do we deliver more value to our customers as the impact that we create as a company can grow. Now, in that scenario, an exit talk can be a really healthy thing. Like, for instance, if you have a board of directors in your company, put it on the agenda once a year. We're going to talk about exits. We might not be selling this year. We might not be selling next year or the year after that. But we want to make sure we're aligned in terms of where we're coming from, what your timelines are, what the threshold price is that we would know. To an investor, for instance, they have timelines. They have funds that they have to return capital to their investors. I'd rather know that pressure that my investors are feeling versus being in the dark and sort of making assumptions around what our longevity is around the company. And these are awkward conversations, but it's best had openly and transparently and in advance. And then finally, we've already mentioned the FAIR framework. It really is the 4 critical elements of what a good exit looks like. It's not just about price. It's about finding the cultural fit, ensuring that all parties are aligned, having a sound integration strategy, and a rationale that we can sort of get behind for many, many years to come.
All right. Mark, just anything you want to add to that?
There's also some very practical advice around a term sheet, for example. We take a term sheet and we break it down and we simplify it and we explain the elements of a term sheet. And, there's one of our stories in the book, a very famous lawyer in Silicon Valley said, you can't outsource judgment. So part of our advice is find the best advisors you can get, hire the best M&A attorney you can find, good tax help, right? Good financial advisors on the back end. We work with UBS. UBS has been sponsoring the book. They've been great partners. And we, as a CEO, as you have to be responsible for understanding the legal documents. You cannot outsource that. And the book helps.
All right. Well, I think we covered it pretty well. Mark, where do we find the book? I assume it's on Amazon, or it's going to be on Amazon and wherever fine books used to be sold.
It is indeed. So it's on Amazon. You can go to our website, exitrightbook.com, and hopefully it'll be in most major bookstores.
All right. Hey, gentlemen, thanks so much for coming on. If you got a question for Mark or Mert, you can shoot me an email, kl@kerrylutz.com. Don't forget, go over to the site, financialsurvivalnetwork.com. Sign up for your free newsletter. Mark, Mert, thanks so much for coming on.
Thank you.
Great. Thank you, Kerry. Thank you very much.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.